entire market panel with the major averages all up around 1% on the week. This is the 45th record close this year for the S&P 500. Joining us now, Victoria Greene of G-Squared Private Wealth. She's also a CNBC contributor, and Ryan Detrick of Carson Group. It's great to have you both. Ryan, I am going to start with you, given the fact that we have record closes again for the S&P and the Dow. And tomorrow, I know it's Saturday, but technically it's 2 years. It marks 2 years for the bull market. You've been very positive on stocks for the better part of that 2 years. How do you see it now?
Yeah, happy Friday, everybody. And tomorrow is the birthday. The bull turns 2. And I think it's really important to note. So the S&P, I'm not exactly sure with today's close. We're up over 60% these past 2 years. And you look, Morgan, at the average 11 bull market since World War II. The average one lasted over 5 years, like 180%, median well over 100%. So I think as people kind of, hear about this bull market hitting 2, it's important to note, yes, this has been an incredible run, no question about it. But there could be a good deal left. And we can get into the economy and things. The economy is still solid. The Fed is no longer headwinds. I mean, the reality is this bull market's really beautiful, but it really could have a lot left to it. And that's how we're positioning ourselves here.
Victoria, I want to get your thoughts, because there are a lot of push-pull dynamics for this market, both on the macro and the micro. But particularly interesting today that with J.P. Morgan's earnings, the CFO on the conference call basically said that what they're seeing in the results lines up with a soft landing scenario. And so some folks are taking that to mean that they're basically calling it, that the landing is in and it's soft. I would debate that, especially based on Jamie Dimon's comments from earlier in the week in an interview. But just lay this out for me. If we do, in fact, have a soft landing scenario, what needs to happen from here, given the fact that valuations are stretched, but we do have earnings getting underway?
Yeah, it's all about earnings growth, right? We got to justify the PE, and we may see the earnings growth continue to come up and keep multiples about level. I will always say JP Morgan and Jamie Dimon is always a little bit negative Nelly before earnings. And he talked about, again, we have all of these traumatic things happening and the end of the world may be coming. But my company's doing just great. And we beat again and actually earned higher net interest income than analysts were expecting. So for me, I look at this and say, if earnings keep growing, then we're in good shape. If rates, we don't see a spike in yield, we don't see a spike in unemployment, then we're in good shape. And I think also the scenario of the no landing is definitely on the table. If there is a soft landing, we're already in the middle of the soft landing. I think people keep waiting for a shoe to drop. I don't think a shoe's going to drop. I think if anything, it's soft or no landing at this point. The Fed has done a good job. The market's absorbed a lot. I know, you've seen yields back up about 50 basis points as Fed speaks come out hawkish. We've gone from 50 basis point cuts in November to 25 to maybe none, what Bostic brought up today, but the market's fine with that because they're pivoting to earnings. And I look for catalysts. Today was a great first kickoff day. I mean, the banks just crushed it. I'm really excited for next week. I think we're going to see some easy beats here. And it's actually a lower bar. Remember, we're now only expecting about 4% earnings growth versus 7% when we started Q2. So I look at this and say, I think bull market's middle innings, keep calm and rally on.
Yeah, and that is a good point, too. The fact that you have seen yields move back up towards those August highs, Ryan. If I look at some of these cross currents, whether it's Fed, whether it's earnings, whether it's China, whether it's disinflation, whether it is some of the more specific stock stories out there, like Tesla today. I mean, we know from a seasonality standpoint, October tends to be weak. Do you buy on the pullbacks here, assuming you get them, or is this really a market that's turbocharged where maybe we don't get them? And if so, what do you buy into?
Yeah, great question there. Listen, the S&P is up 5 months in a row, 10 of 11 months. I mean, this is awfully stretched. October, when you're up 20% for the year heading into it, like we were this time, only been higher 2 out of 9 times. So let's just remember those pre-election jitters. We still expect to see that. I think it'd be fairly contained. I mean, we 8% pullbacks, all we've seen so far this year. We don't think it'd be anything more than that. Maybe one of those quick 5%ers or so, perfectly normal. But, the discussion we just had, what's leading? I mean, financials hitting all-time highs. I've come on all year with you saying we like financials. We like industrials. Yes, I know small caps be a dirty word. Small caps up 2% today, 11% on the year. Not great, but historically you find alpha out of small caps once they start cutting. So small and mid caps, 2 areas we like, and those cyclicals are still areas we like here, Morgan. But one final thing, advanced decline lines, market breadth, right? New all-time highs today on like the NYSE advanced decline line, S&P 500 advanced decline line, more at small cap, mid cap. They all hit a new high today. What does that tell the listeners? Market breadth leads price. We saw those advanced decline lines breaking out in May. I talked about it back then in May, saying maybe it'll be a summer rally because breadth is strong. Market breadth is still strong. It's not 7 stocks anymore. It is a lot more, and that's something to be thankful for.